What's up, everybody? What's up, everybody? Welcome to the second webinar that we are hosting. Please do drop a comment down below. Let me know if you are here and if you're excited, and if you are with us, let me know if my sound is also fine. So drop a comment down below. Let me know if my sound is fine and if you guys can hear me. Just drop a comment down below. Drop a comment down below. Let me know if you can hear me. Drop a comment down below. Let me know if you can hear me. And please do share the live broadcast as well. Do share the live broadcast as well with your friends, just so they can know that we are live and we are having our second webinar today. So on today's webinar, we are doing Forex basics. But before I do start, please do drop a comment down below. Let me know if you are here and if you can hear me. I see people are coming in, people are joining. Stays in. I see Ray from George ready for the second workshop. I'm so excited to have you come back for the second time. Who else is here and joining us for the second time? I see a lot of people are coming in, people are joining us. Thank you so much for joining in. If you are here for the second time, please do let us know, and we are excited to have you once again. This is once again the second webinar that we are having. This is the second session and lesson that we are having. So I'll give you guys like a few seconds to share the live. If you've got friends that are interested in trading, just do share the link. Let them come on and hop on. Do share the link. Share the link with your friends. Share the link with your loved ones. And we are live. So I'm just going to give you a few seconds as we go through the disclaimer to share the live with your friends. So this is our disclaimer. Any opinion and use research, price analysis, or any other information discussed in this webinar, a link to this presentation is provided as general market commentary and does not constitute investment advice. So this is our disclaimer that we do have on today's webinar. So once again, guys, welcome back to the second lesson that we are doing today. So if you came in late, as you can see, we are doing our second lesson, and we are speaking about Forex advantages, and we have got bonuses for participants. We've got 100% bonus. After attending the lesson, you will be given a promo code to use, which will obviously give you a 100% bonus to double your deposit and to be able to maximize your profits. And then you will get a certificate of attendance at the end of every lesson in this course. And again, you will get a trader's guidebook in a PDF format. And this is an exciting thing that I cannot wait to see you attain at the end of our webinar. So now that we are done with that part, let's get to the good part. Again, guys, if you are here, I would like to know more about you. For the guys that were here the last time, they do know that before we start, I would want to get to know you just a little bit better than, I see your names right there. So I want to know who you are. Like, just let me know. Let me know who you are and where you're from. Let me know what you're about. What city are you from? What your name is. Just so I can know that we have people on here that are real people, and that are excited to actually learn from me today. So I see someone is saying this is Pamandla from PTA and here for the second time, knowledge over everything. Thank you so much, Pamandla Shongwe, man. I appreciate you, brother. Who else is here? Just drop your name and where you're from so we can give you a shout out before we actually start. So just drop your name on there and your province, where you're from, your country. If you're from South Africa, let us know, and then we will know that you are here and you are with us. Okay, so yes, drop a comment down below before I do start. Just drop a comment so that I do know that you're here and that I can give you a shout out. Thank you so much, guys, to everyone who is on here. So just drop a comment before I do start briefly. And once again, you guys, as you've already seen on the first episode, my name is Dr. Martin, and I am a professional Forex trader with 7+ years of trading experience. And I am a trading coach and an analyst. I specialize in market structure and trend trading. I see you, Koketo from PTA. We welcome you. We welcome you. I see, thank you, Mnaga, currently in Mpumalanga. Happy to have you, Wallet. Happy to have you. So I see it teaches traders how to manage their money. I teach traders how to manage their money and how to find their trading style. And once again, as I did mention, I have trained plus minus 10,000 individuals in my life. With a 6,000 like number online and about 4,000 in person. So I do have quite a large number of people that I have trained how to trade, and I am very excited today to be sharing my expertise with you guys and showing you exactly what I do know. I see there is Takane from Puta di Chaba, Gagwa in the Free State. Welcome, man. Happy to have you on here. So now that we have gotten that out of the way, we are looking at the advantage of the Forex market today. And secondly, we're going to be looking at trading sessions, and we're going to be looking at when to trade, and we're going to be looking at the terminology. We're going to be looking at leverage, take profit, and stop loss. And I do think that, again, these are the most fundamental issues and factors that you do need to know, excuse me, as you are trading, and these will help you greatly and immensely in your trading career as you are starting out. Okay, so now the next thing that we have, I'm going to be going through these advantages in the Forex market. So the first thing that you need to understand that we do have a lot of advantages of trading the Forex market. The first advantage that I would give you is that the Forex market has a high liquidity, and this is a $7 trillion market on a day-to-day basis. So we've got about $7 trillion every single day that circulates in the markets, which makes it advantageous for us to trade, because then that means we're going to be making more money in this market. Okay, and then again, the Forex market is a time flexible industry that allows for you to trade 24 hours on a daily basis and 5 days in a row. So from Monday to Friday, you can trade the Forex markets, and you can trade them for 24 solid hours on a day-to-day basis, which obviously puts people that don't have enough time as they are at work to trade even after hours. So the market moves for 24 solid hours. That means that you can also be able to catch these moves even as you get time later on in the day. So this becomes then a great advantage as you are trading. And now again, we've got high volatility in the markets, and this volatility is induced at any given time. So this market is a highly volatile market, and that means that you can actually profit and benefit so much from the moves that come from this volatility in the markets. And again, we've got various tradable instruments in the market. We've got currency pairs, we've got we've got indices, we've got stocks, and we've got a whole lot of tradable instruments in the Forex market. And this makes it a market that gives you variety of choices that you can obviously choose from in order for you to trade what also suits you as a person. There's different trading styles, and you can actually choose and select any of these instruments that are there to trade and be able to trade according to the kind of person you are as well. And we have got very minimal commission, unlike other markets. There's other markets that will give you high commissions and high charges when you're trading them, but in this particular market we've got zero or even minimal commissions in this market. And then we have got leverage in this market, and the leverage in this market also is actually quite a very large advantage that you do want to actually focus on, because it allows for you to enter into the markets with with funds that are granted to you to be able to trade in the market. So they give you a number that allows for you to be able to to trade in this market, and the leverage on there helps you be able to make even greater amounts. And you'll see even as we go through our lesson today. And you've also got the chance and the opportunity to practice free on your demo account. So instead of you being induced into the market, so you diving straight and directly into the market, you're able to even practice with your free money even as you are starting out. Now we've got the first slide that we are going through today, and the first slide would be our trading lessons, right? So on the trading lessons that we do have over here, we have a lot of sessions that we do have, mainly 4 sessions. We've got the Sydney session, the Tokyo, the London, and the New York, right? So these currencies are traded 24 hours a day and 5 days a week around the world, as I've mentioned. And the trading market opens Monday morning in Wellington, right, as they stated even on this slide, and it opens till the Friday night in the New York session, right? So now as we are looking at these trading sessions, the market moves in these sessions, right? So the Sydney session will obviously start at 10 p.m. and closes at 7 a.m. and the Tokyo section would obviously start at 1 a.m. until 10 p.m. The London session would start at 8 a.m. until 5 p.m. and the New York session would start at 2 p.m. until 11 p.m., right? And these times are listed in GMT +1, and obviously you can convert these numbers again and according to the country that you're in. And please do note that these times are listed in GMT +1. You can obviously convert these times to the country you are watching from right now. So now these are the session times that we do have, and all these session times have their own pairs that actually get activated in those sessions. So for example, in the New York session, all New York pairs will be active and moving in that session. So whenever the New York session starts, that purely means that all the US pairs, or rather the pairs that have got the USD on them, will be moving in that specific session, because then that's when the session has come into play. Not that they will not move on the other sessions, but then in this session, that's where most volatility will be induced into the market. So you need to now understand that in the New York session, the US pairs will be more volatile, and in the London session, the GBP pairs will be more volatile, and in the Tokyo session, the JPY pairs will be more volatile, and so forth. So you need to understand then how these sessions work, because the minute you get to understand these sessions, then this helps you even get to try and get the moves exactly at the sessions. Try and trade these pairs exactly at the sessions where they move the most. So it's important to understand when these sessions open and when they do close, so that you're able to capitalize your moves and maximize your profits based on the volatility that is induced into the markets based on the session times that we do have. And then again, it is important to understand when to trade, right? It is important to understand when to trade. So other than weekends, there are just 2 public holidays when the Forex market is closed, and those are particularly Christmas and New Year's Day. So these are like the only 2 holidays that the market will close on other than weekends, okay? And then we do have open and closing times that are based on local business hours, with most businesses starting somewhere between 7 and 9 a.m. Local time. And the Forex market opening and closing hours changes in March, April, October, and November as countries move to daylight savings. So whenever you'd see that, particularly in South Africa, the US Open moves from 3 p.m. to 4 p.m. That's normally because of the daylight saving time that happens, and Japan doesn't observe daylight savings, and that's important to understand. So these are important keynotes that you need to note down and ensure that you do understand. And it's important to trade when at least 2 sessions are open, because the market tends to be more volatile at that time, as I did mention even on the previous slide. So please do kindly let me know if you are still with me. If I'm too fast, also do let me know. Do let me know if you are still following, just so I can know that I am still speaking with you and that you guys are still understanding. But in essence, this is exactly what you do want to understand. So we have what we call the London London breakout strategy, right? So this is essentially the London breakout trading strategy, and this is a popular strategy used by traders to identify potential trading opportunities during the open of the London market session, right? So this happens exactly at the open of the London market session. So then we've got this explanation that says this is the London range, that the trading range established by the market before the London market opens. It is the trading range of the Asian session, and this would be obviously identified by the support and resistance levels. At these periods are the key levels for setting buy stops and sell stop orders, right? So I will demonstrate what this means right now. So this is the London break strategy. That means then at the London session, you identify the range that happens in the Asian session, and you would want to obviously trade now upon the break of that range that was established in the Asian session in attempts to get a move that would obviously give you profits in the London session. So you're trading that London break. So when we say it's the London breakout strategy, we're practically saying to you that you're catching the breakout that happens from the range that was in the Asian session going into the London session, and you're catching the breakout on there, and then you're obviously going to be trading that buy stop or the sell stop according to what you would have set in that specific market, according to your support and resistance levels. Okay, so now I'm going to go to the MT4 and explain what I do mean by that. So I'm going to go to the M15 time frame for the sake and the purpose of what I'm talking about. So as I did say to you guys even on the last session, that you can open your MT4 account and whatever. So what I usually do when I do this is that I will want to insert so I'm going to go to properties. Okay, so when I do go to properties, I'm going to go to common. Let me see. And then I'm gonna show period separators. So the period separators that I do have, right? So the period separators that I do have show me the days that occur in the market. So if you look at my chart over here, you'll notice that I do have these dotted lines over here. So each column on these dotted lines represents one day, right? So it represents like a single day. So if you look at this from that dotted line to that dotted line, that's one day, right? So that is the 16th of May. So if you look at the timeline at the bottom there, you'll see that this is the 16th of May till the 16th, and today is the 17th. So that's why that's a new column, and there we had the 15th, right? So now the London session, according to the times that we spoke about, obviously starts at what time. So let's go back and double check there. So it's important to understand all these things, right? So the London session, according to what I said, starts at 8 in the morning, right? So now we said that the Sydney session is what we want to establish again. So the Sydney and the Tokyo, that's the Asian session. So we're going to look at the Asian session. So let's practically observe the Tokyo session, right? So that would be from the 1 a.m. until the 10 p.m. session. So we're observing that, and then the 10 p.m. till the 7 a.m. So both these sessions overlap. I don't know if you guys can see that, right? So this starts at 1 a.m. till 10 p.m. This starts at 10 p.m. till 7 a.m. before the London session. So we're going to observe at least that 10 p.m. window till the 7 a.m. window. So that's what we're observing, right? So we're going to be looking at that 10 p.m. till the 7 a.m. window before we can get the London break that would obviously be activated until 5. So let's then go back to our MetaTrader. So we're going to pull out our crosshair over there to observe our time. So if we look at this, right, at the bottom there we have our times, right? So we've got our times at the bottom. So over there we can see that, okay, prior to that we've had so our support level over there. So I'm going to be drawing that support over there. So I'm going to be drawing that support. Why? Because the support level that we do have over there started when it started around like 9:30. So if you look at that 9:30 level, so that's 9:30 for 10. So that's the support level that we did have over there, right? And then we did have that resistance point that was printed over there. So the resistance that's printed is obviously there, right? So that's the resistance that we do have. So now the market was moving within these two lines, right? It was moving within these two lines up until when up until 8:30, right? So up until 8:30, that's when we broke out of the two lines. Okay, so now if we go back to the times that we spoke about, so the London session starts at 8 in the morning, right? So we're observing this and we want to see what happens upon the break of upon the open of London, because remember that according to what we spoke about and established, we said we want to monitor and observe the London break strategy. So we want to be able to trade based on the London breakout, right? So then the market obviously then comes and breaks past that support level, and it kept it, and then it went down. So obviously from there you would have backed a solid amount of pips going to the downside, came back again to that same level to retest within the same day, and went down again. So again, you would have either manually caught this or you would have set a sell stop. So if you wanted to put a sell stop, so you would obviously say trading. So you can see we've got a buy stop, or let's say a new order, right? So a new order rather. So we were going to set a new order over there. And once we set a new order, so type market, we're going to say it's a pending order, right? So it's a pending order instead of a market execution. So we're going to say pending order. So what are we looking for? So we're going to say either a sell stop or a buy stop. So you're going to set either a sell stop or a buy stop. And your sell stop and your buy stop, where do you set them? You set them just above that resistance and below that support, because you want to catch the move that happens upon the break of either side. So you're going to be saying you're going to be taking that price, over there, and you're going to write 2013.20. So if you're setting your sell stop, then you would have obviously set it at 2013.20. So let's say it's a sell stop now, so you would have clicked sell stop, and then your price would have been, so you can erase all of that, in 2013.20. okay, so that would have been 2013.20, and then you would have placed that. Okay, wait, oh yeah, so 2013.20. What I forgot to mention as well, you would want to obviously put your stop loss. So your stop loss would have been above this level. So your stop loss would have been above that resistance. So your stop loss would have been 2018.91. So your stop loss would have been 2018.91. And your take profit then would obviously so you need to then calculate your risk to reward. For me, if I'm risking this much, then I would obviously either want to target the same amount or even twice that amount, but also we're still going with our lesson. So you would obviously maybe even want to target like pip wise. If you want to target 30 pips a day and you're risking 15 pips, that would be a 2:1. So suppose your take profit was say around this level, 1997.50. Let's put it there. So 1997.50, right? So that would have been 1997.5. So 1997.5, then you would have obviously clicked place. Please just pardon me. Let's see, 2018.91. Okay, so sell stop. Oh, flip, you know why? I think that's because the market is far ahead. But that's how you would have set your sell stop. You would have put your stop loss there and your take profit there, and you would have placed it over there. So the reason why it says invalid is obviously because now the market is way ahead of where we are right now. So we can still demonstrate even with our current market, but your sell stop would have obviously been here, and when the market breaks out of that level, then you would have been able to activate that entry, and the market would have been pushing to your direction, as you can see. And again, we could have still used the same sort of like an example even here, and even as you can see, we've had the support level over there in this particular market. So you need to check the time of the session as well. So 10 p.m. of the previous night would have been 10 p.m. would have been around about there. So the support level that we would have had in this instance would have been this one over there. So this would have been the support level that was established in that session, and then the resistance would have been this one over there, right? So that would have been the resistance over there. So the sell stop would have been obviously placed below that level upon the break. And if you observe when the market broke out of that level, you would have seen that the market broke out of that level. So it broke out around here. So the London breakout actually happened over here. So I mean, you can see over here we faked below that level, came back above, and eventually broke out over here. And the market has been going down ever since. So your sell stop could have still been activated. So that's how you would obviously want to activate your sell stop in this particular instance. And you can, backtest this with different pairs, and that's how you would have obviously traded the London break strategy using, your sell stops and your buy stops as well. So that's how you would want to trade your London break strategy. So can you guys hear me? Can you guys hear me? I see a comment. Someone says check your volume and network. I'm not sure if it's on my end or it's on your end. Can you kindly please comment down below if you can hear me, and let me know if you can hear me. Let me know if you can hear me before we move on further. Let me know if you can hear me before we move on further. Before we move on further, please kindly do let me know if you can hear me before we move on further. I hope you guys can hear me. I hope you guys can hear me before I move on further. Please do let me know if you can hear me before I move on. Please do let me know if you can hear me before I move on. Okay, I'm assuming you guys can hear me. I'm assuming you guys can hear me. Okay, beautiful. That's beautiful. And then again, what we do have now is we have the terminology that we are looking at. So when we speak of terminology, right, we're going to say there is, going long, and there's also going short. And when we speak about the market going long, we're saying the market is buying. And when we're saying the market is going short, we're saying the market is selling. And if we speak about a bullish market, that's a market that's in a bullish trend or like an upward trend. And when we speak about a bearish market, we speak about a market that's in a downward trend. And when we speak about bulls, we speak about buyers. When we speak about bears, we speak about sellers. And when we speak about a ranging market, we speak about a market that is either moving up or downwards, but also moving sideways. So the same word ranging is the same word as sideways. And then again, when we speak about a trending market, we speak about a market that is moving towards a specific direction. When we speak about a hawkish market, this is when the CBN is in support of raising the interest rates to fight inflation, even to the detriment of economic growth and unemployment. When we say it's dovish, it's when the CBN is in support of cutting the interest rates to favor economic growth and employment. And these are important terminologies to understand, right? So there's a few nicknames over there that they do have on there. And we have got USD, which obviously means greenback. We've got GBP, which means cable. So cable is the same word as GBP. Kiwi, that's NZD. Aussie, that's AUD. And Loonie, that's CAD. And black gold, that would be oil. And then again, what we do have, we have lot size. So in trading, lot size refers to the amount of currency units that are being bought or sold in a trade, right? So this is a standardized measure to help traders manage their risk and exposure in the markets. And how you can set your lot size is exactly over there. A lot of people do make this mistake when they are trading, that they don't double check their lot size to actually check whether they are trading in the right or wrong direction. So I mean, with the right contract sizes, sorry. So they do not double check over here to either check whether they are over risking or not whenever they are trading, and that's an important element and piece to actually understand. And then there are three main lot sizes used in Forex. We've got a standard lot, a mini lot, and a micro lot. Excuse me. So a standard lot is equivalent to 100,000 units of the base currency, And a mini lot is equivalent to 10,000 units of the base currency, and obviously a micro lot is equivalent to 1,000 units of the base currency. So a standard lot would be a 1.0, a mini lot would be a 0.10, and a micro lot would be a 0.01. So choosing the appropriate lot size depends on a trader's risk tolerance and account size. A large account may allow for trading with standard lots, while smaller accounts may be limited to micro or mini lots. The lot size also determines the pip value, which is the smallest measure of price in movement in trading. So now, for example, right, so three traders bought a currency pair with the standard mini and micro lot respectively. With a 20 pip move in profit, here are their respective rewards. So if you bought it with, so the one that buys with 10,000 units, that's a standard lot, and that would be a 200 reward if the market moves with a 20 pip move, right? So if they buy with a standard lot, that means they make a $200 that would be a $10,000 reward with a 200 standard move that happens over there. Excuse me, just 1 second. So yes, so 1,000 units, 10,000 units, and 1,000 units, right? So this one puts in $10,000, puts in $1,000, puts in $100, right? So that's a standard lot, and this is how much they get to make. So these are their rewards, right? So they get to make, this one gets to make $10,000, this one gets to make $1,000, this one gets to make $100, mainly because of the number of units they all put with their respective account sizes in this respective example that we do have. Okay, and then we also have what we call leverage. So leverage is having the ability to control a large amount of money using none or very little to your own money, even as I did explain when we started, right? So now, for example, $1,000 starting balance, and you've got a leverage of 1:1. That means you've only got 1,000 units, and that's a 0.10 on the value of a pip. And you would obviously so the 100% return on that would be 10,000 pips, and so minus 100, that would be 10,000 pips, and plus 100, that would be 10,000 pips as well. And then you can obviously check these examples. So that means so if you've got a leverage of 1:500, that then means you've got access to 500 units, and that means you've got $50 at the value of per pip. So you've got 20 pips like that. So that the more the leverage, the higher the leverage, the more amount of money you have at your disposal to trade with. That means you can obviously open more positions. You've got more value in the pips that you can open. So the higher the leverage, the better you can trade. So and the more riskier it is for you to trade. So the most recommended leverage to use would obviously be the 1:5, because this is obviously a very standard leverage that you can obviously use. Okay. So now we also have take profit and stop loss as well. So TP is an order that's sent to your broker to automatically close an open position in profit at your preferred price. It holds any further advance in profits guarantees a specific profit after a level has been hit. So if you do set your take profit, you know that the market is going to move to that specific area, and once it gets there, the market is going to automatically and manually close your trades without you stressing whether your trades are going to close or not. So once the market gets your take profit, the market will manually close your positions. And as stated here, it holds any further advance in profits and guarantees a specific profit after that specific level that you have set gets hit. And again, there's a stop loss as well. So a stop loss is also another form of order that's sent to the broker to manually close your trades once your loss has gets to a certain preferred price, should the market go against you. And it also holds any further advance in the loss of your capital. So why do you need your stop loss and your take profit? Your most important job as a trader is to manage and preserve your trading capital, right? So your stop loss orders are implemented to ensure that losses won't grow too big. So it's important that you set your stop losses, because once you do set your stop loss, your trades will actually not go further than the levels that you have obviously set. And once you set your take profit order, your take profits as well. So your take profits will be implemented in your orders to ensure that your profits can also be secured into your bank account should the market reverse as soon as it hits that anticipated level. So it's important to set your take profits as well as you are trading. And then once again, I will show you how to set your stop loss and your take profit. So suppose we are trading in this market. So number one, let's practice lot size. So this is where you change your lot size. So as you can see, I've got a 0.01. So I'm going to come here and change my lot size. So that would be a 0.50. So let's say I want to trade with a 0.50, okay, and I'm going to put a buying order over there. So I'm going to accept all these conditions. This happens if your account is still new. So I'm going to accept all conditions, and then I'm going to put my buy over there. So the minute I buy over there, right, so I will set my stop loss at this area. So my stop loss would be, if the market comes and breaks past this level, then I want the market to manually close my accounts, right? Even when I'm not there to monitor all the moves that happen. So that price that is there is 1979.19. So I can either drag this green line to that area, to that 1979 level. I can either drag that line and my stop loss will be put there, and drag this line if I'm buying, right? So if I'm buying, guys, if I'm buying, I will drag it below my order, and if I'm selling, I'll draw this line above my order. But because I'm buying, I'm dragging it below my order, just so if the market gets there, I know that it's gonna manually close my trades automatically. And as my take profit, I'm gonna drag it to the highs. So I'm gonna say if it gets there, that's where I'm taking my profit. So that would be my TP. So that's the first way you can obviously know how to set your targets. That's the first way you can set your targets. And again, if you put that arrow on this line, you're also able to see how much you're profiting. So if this order gets to our target, then we're making $300 on this order. If it gets to our stop loss, we're losing about $144. Okay, so that's how you can set your stop losses, and that's the first way you can use to set your stop losses. Now the second way, let me cancel both this stop loss and the take profit. So now the second way that you can use is this way, right? So you look at this price over here. So that would be 1978.90. So what you would do is you want to right click and click modify and go to this order. So this is the order that's open. So you will be modifying that open order over there. And then what you want to do then is to modify the stop loss there. So you want to modify stop, so copy as, so your stop loss will be 1949. So we said that that's 19, that's 19, that's actually 19, that's 1979 actually. So let's say our stop is at 1979. That's not 19, oh yeah, that's 1979. And then our take profit is at our take profit would be at let me see, let's say 1990. Okay, let's say 1990. So what we need to do then again is to modify, and then we go to take profit again, even on the same order. So you then go to 1990. So then that's where you would want to set your take profit. So the take profit would obviously go to 1990. So that take profit would be 1990. So that's where the take profit would be, and then you click modify again, and then you will see your take profit will just come up in a second. So that's where your take profit will be again. So that's exactly how you want to set up your take profit and your stop loss. So there's two ways to set up your TP and your stop loss. That would be manually dragging that line to either take profit or stop loss, or again is to do it in this fashion and way that I just did it. And once again, this is my personal promo code that you can use until the 1st of June to double your deposit, and it can only be used once. So if you do want to double your deposit, you can use this this promo code on the screen over there, so you can copy this promo code and you can paste it on to your account there on the client portal, and you will be able to double your deposit. And once again, guys, I will be asking you quick questions. So what is the opposite of a trending market, and which currency comes first in a currency? Which currency comes first in a currency? So I want to know, guys, if you guys have been following. I want to know if you guys have been following. So what is the opposite of a trending market? What is the opposite of a trending market, guys? So I'll just be waiting for you guys to respond on the comment section. Just respond there on the comment section. I'm just waiting, going through your comments now. Going through your comments now. So what is the opposite of a training market? Please do drop a comment down below. Please do drop a comment down below. Please do drop a comment down below. What is the opposite of a trending market, and which currency comes first in a currency pair? Yes, you're right. Dominique, you're right. So the opposite of a trending market is a ranging market. You are right. And which currency comes first in a currency pair? I covered this even in our previous session. I covered this in our previous session. Base comes first. Yes, that's beautiful. And then how many units of a currency can you buy or sell with 3 standard lots? How many units of a currency can you buy with 3 standard lots? I just covered this today, guys. I just covered this today. What is how many units of a currency can you buy or sell with a 3 standard lot? How many units can you buy with 3 standard lots? Okay, it seems you guys are unable to get that. Let me skip to the next one. I'll come back with the answer to this whilst you guys are thinking. So now, what is the trading power of a 6,000 trading account with a 1:100 leverage? What is the trading power of a $6,000 trading account with a 1:100 leverage? I just covered leverage today. Do drop your comments down below. Lucky Masego is right. So that would be three times the number of units you mentioned. You are so right. So you're very right, sir, because we did say so. Going back to what we had said, right? We said that with one standard lot, you qualify to trade 100,000 units, right? So if you've got three standard lots, you can now buy 300,000 units with three standard lots. That's what we had established even earlier on. So you got Lucky is correct with that response because then you get to purchase 300,000 units with a standard lot of any of a currency pair that you can either buy or sell, right? So congratulations to you. And take profit and stop loss orders work even if a trader is offline. True or false? True or false? This one should be the easiest. True or false? True or false? True or false, guys? True or false? Take profit and stop loss orders work even if a trader is offline. True or false? True or false, guys? True or false? This is the easiest. True, that's very true. So as we did say that um, stop loss and take profit would work even when you're away from the markets and the charts. So that is very much correct. So I'm going to open up space for questions. So if you do have a question, do drop it down below so I can respond to your question. So do drop it down there whilst I am waiting for you and reading your comments. Drop it down below and let's respond to your questions. Drop it down below. Let's respond to your questions. Drop it down below. Drop it down below. You guys have been such an amazing audience. Drop it down below. And we're having our third session next Monday. We're having our third session next Monday. But before we end today's session, just drop your questions down below. Drop your questions down below. If you do have any, drop your questions down below. Okay, it seems all of us are satisfied and all of us are good. So, what we do have next week is that we're gonna learn how to analyze the Forex markets. You do not want to miss this. We will be going in depth in how to analyze the Forex market, and we'll be looking at fundamental analysis, we'll be looking at technical analysis, we're gonna be looking at market trends, we're gonna be looking at chart patterns. So, this is important that you do come on and you come and sit and learn how to do all these major points that we do have. So it's important that you come and you attend next week's session, right? So it's important. Um, it's important. You're welcome to ask our speaker questions. Yes, please. Can I just okay? I see. There's a question. How much money do you need to trade in rands? It really depends on how much you are willing to risk. So if you can afford to risk, like 1,000 rands, you can trade 1,000 rands. If you're willing to risk 2,000, you can trade 2,000. So you can only invest what you are willing to risk. So you do not trade money you're not willing to lose. So when you invest into the markets, you invest money you are willing to risk, and that's how much you can gauge yourself. Um, In a standard account, what is a stable account to trade? Like in a standard account, what is the stable account in rands to trade indices with a 0.01 lot start trading? Um, it so with I think like from a minimum of $100, you can obviously start trading indices. How much money does one person need to trade in rands? I think I just responded to that question, and I think that's just about it. So, guys, you should be coming on to next week's session because we'll be learning all these important factors as I did mention. And thank you so much for joining in once